The 10-year yield, trillions, rule everything. It rules equities, stocks, derivatives, cryptos like Stellar XLM. Trillions only flow in reaction to the bond market, because that is a major indicator as to what is happening with the markets. Today I'm picking up on the previous video that I did on the 10-year yield technical analysis, TA part 2, and we need to find out what the economical data is telling us. We need to find out what actually, in fact, the yield curve is doing. We need to find out what the CPI data is, the money velocity, where this money's gone from the M1. And when I mean the M1, I mean the money printing that's happened. We need to look at that chart and see what's happened. So, without further ado, let's jump over to the charts. Okay, great, thanks Nathan. So we're looking at the US government bond, the 10-year yield or 10-year yield treasury notes, right? Okay, this is the percentage. So you have a premium, how much the bond cost, and you have a percentage at the interest rate in which you get from that bond, which is currently sitting at 2.875. Okay, so when we last looked at this, we were trying to figure out how the yield, the 10-year yield controls, and the bond market controls the rest of the market, because the rest of the markets, equities, stocks, cryptos, they're all derivatives from this US 10-year yield. So the debt market controls what's happening in the other markets. So as you can see, when we last saw what Joe was talking about, he said, and he is pretty much predicting that it would come up past 3, come up to about 3%, which it has done. And we could expect some serious impacts, some serious high inflation. We can expect the Federal Reserve to raise interest rate basis point after like several basis points at a time, which we've seen quarter by quarter. Interest rates have gone up, right? So Joel's been quite accurate in predicting that and determining that. But what's going to happen now? We can see that it's risen from 1.63 from November 2021 to now, I've got to think about that, August 2022. We could see that clearly it's gone up way past 3%, and now it's come down. And we've got these waves, I want to say they're waves of equal length. Let's check the bar pattern on here and just see, try and realize a wave before we get a correction. We got waves of equal lengths coming down here roughly, yeah? Not quite, well, it's close enough for me, more or less, waves of equal lengths, yeah? And we've also got this head and shoulders pattern, as you can see there. If I can get this off the screen. We also have a head and shoulders. I don't use it often because it's quite a primary pattern to print. But let's have a look. So head and shoulders is really a primary indicator. It's one of these primary indicators that you can use, that most people understand from the beginning of their trading careers, if you like. So we got this what looks like a head and shoulders pattern. We're getting this neckline right here. If I could draw that in accurately, thank you. There's your upper shoulder, it's about that level, and we're above that 10-year yield percentage as to where we are now. Bring that down, there we go. There is your head and shoulders pattern. Okay, no one can dispute that. That's a perfect head and shoulders pattern, neckline, shoulder, and everything. And the way to get an idea of how far we've got to drop from this pattern is by measuring from the top of the head. Don't want that, thank you. Top of the head to the neckline. So that's 24% from the neckline to the bottom. So if we're looking at 24% drop from a head and shoulders pattern, we're talking about a move down to around 24. Where are you now? 24, you're there. To around 2.05% interest rates on the yield curve. Yeah, so it takes us way down here. And actually, when you think about that, that brings us right back down to its previous high, its previous swing high on the 10-year yield. So that actually makes a lot of sense. Now, real quick, I just want to point out something on this head and shoulders pattern, that if the 10-year yield rises above 3.15, then this whole pattern is invalidated, which means that it's more than likely to continue its current trend, which is an uptrend. Okay, so we could see that rise potentially up to 4%. Now, it really is going to depend on what the Federal Reserve are going to do. I mean, really, you know, if they're going to continue with a plan to sell treasury bonds, then that 10-year yield is going to rise. But we'll know this because we'll be able to see technically, you know, that strong, very strong bearish pattern has been broken and a trend is going to continue. That makes absolute sense. You could see that the clear head and shoulders pattern indicates to us that the 10-year yield should be dropping down to about 2.05, just touching its previous swing high, possibly before we get some consolidation. Where bonds are being brought up, you're going to see the 10-year yield fall in value, in percentage yield. And really, I think this is quite possible, even though the Fed is saying that they need to clear their balance sheet, they need to sell bonds. If they start selling bonds, the 10-year yield is going to go further up. So we'll see that invalidation of that head and shoulders pattern, and it should move to around 3.54%. It will just continue its trajectory, its trend, its channel to the upwards position. But this head and shoulders is a good indicator that we've got a change in trend. Okay, and really, when you think about this, we've got to think about stagflation, and with the way, as to what Ray Dalio explained, a long period of channel of stagflation where it's just bouncing between the two. So where the Fed is saying that no, we're going to offload our balance sheet, they're just going to spin and U-turn, and then start actually buying up more bonds to effectively keep GDP afloat. But then that is going to create this period of stagflation, because we've got high interest rates and high interest rates and high inflation. So you've got this period of stagflation, right? That channel moving along where it's bouncing around inside of that channel, and the way it looks at the moment, it looks good for the stock market. It's not good for the economy. We're bouncing along the lines of recession, basically, and possibly staying inside recession. And if it goes wrong, we're looking at a major economical crash, a complete depression. So we need to jump over to the CPI data. Let's check out the CPI data and do a comparison with Joel's in this. So let's check out Joel's, and then we'll compare with what's happening today. So Joel's was back in 2021, November the 16th. Let's look at his data and compare it to our own data today.
Very important implications if that was the case. Now we wonder whether or not, is that just simply because, you know, are we just looking at technicals? Do we have any fundamentals to back that up? Well, quite usefully we do, because at the moment, just last week, we had CPI data come out for the US economy. The CPI data that was released was the highest in the 30 years previous, okay? So a new record for the last 30 years. Yeah, I think off the top of my head it was a 6.2 reading. And we can actually see that here to some degree. All right, we can see here, this is the CPI for the US. And what I've got here is a rate of change indicator. And what you can just see what's been happening is the momentum, the rate of that change, the rate of CPI has been massively increasing over the last few months. You can see that here. If I get rid of this arrow and this arrow here, you can just, you know, so I make that a line chart. You can just see how this is kicked up a gear much more previously to where it was rising steadily, had a little break, and now has been absolutely flying up.
So CPI AUCSL, Consumer Price Index, and that's America's urban areas, all urban areas. Now let's check this out in comparison to Joel's. Now I've drawn this line out from around December. It was actually the 16th of November 2021, but you can see this vertical line up to where Joel's indicator tells us where his CPI data had finished and where's ours has now started. And you could see I've even drawn the line at about 279, which is roughly where, if you look, his data had finished. So right in between the X, and it's continued up. You could see this consumer index price has continued up higher, but it's plateaued at 295. So it was around 279, I believe it's about 278, but it's gone much higher and it's continued its current trajectory. The only time that it flattened out roughly was in about 2000, obviously when COVID had kicked in. That was about the same time when we had that plateau. 2019 we had a plateau there, and then it continued up in its trajectory, and it always has done, but this is a much steeper trajectory. And I believe it's because obviously the M1 money chart, you'll find that that's just like a rocket ship straight up. So many trillions of dollars have been printed, devaluing the currency, and that's pretty much in line with what's going on there. Okay, so we can see from the CPI data that we've got a sort of plateau. Okay, inflation is still extremely high. Loads of debt has been created via all the money printing. Let's just see that in the M1 chart, the money stock chart. This is the M1 SL money stock chart. And as you can see, from the time of COVID 2020, it just had a massive trajectory straight up, just like that, like a rocket ship. And then it sort of plateaued and then gradually sort of still held that trend, that upwards trajectory. And then here we are in August, where you can see it's sort of plateauing. There you go, sort of plateaued, it's dropped down. So money printing has come to a halt. And I think with that you could see that inflation has slightly come down with the CPI data. We sort of got that plateau, that flat line there. Okay, great, thanks Nathan. So looks like yield curve control, inflation sort of reacting. As you could see, the CPI data is sort of flatlining, potentially can dip down, but I think the Fed need to do more. However, we need to see this in another video where we'll be doing some more comparisons with Joel's data to what's going on today. So without further ado, Nathan, let them know what they need to do. Thanks for that, absolutely. So we need to figure out where's all this money gone. As you can see from the M1SL chart, we need to know where all this money is going to be. Watched my previous video on Joel. We find out that it's going into household debt. It's gone into corporate debt, and we need to see if these charts are still receiving this money, or if we've got a plateau, if that debt is still increasing. Is our household still accumulating more debt, and is our big businesses accumulating more debt? However, we're going to need to watch that in another video. So without further ado, I'm Nathan, aka Nathan of Zion. Smash the Zion coin up there. Like and subscribe. It's important that you like and subscribe. It helps us out with the YouTube algorithm. Share, because sharing is caring. And check out the next video. It's on part 3. TA trillions supplied by the yield curve control. See you in the next one. Have a great day now.